Welcome to Voice of the Nation. Now, we are in the second half of 2022, and a lot of people are expecting to see better economy. But instead, we see inflation, rising cost of living around the world, including Thailand. And so many countries decided to raise their interest rate to fight the inflation. How will this impact Thai economy? Our guest today is Kun Wachirawat Banchun, a senior economist of Economic Intelligence Center. Welcome Kun Wachirawat to our program.
สวัสดีครับ
สวัสดีครับ and thank you very much for your time and coming for our program today. Now, the first half of 2022 have passed, and we are now in the second half of this year. Do you expect economy in Thailand to recover further after we open our country and almost all the COVID restriction has been removed?
Yes, of course ครับ so we expect Thai economy to gain further traction for the remaining of this year, right? And just as you said, it will be thanks to the lifted of the lockdown measure in the country and also the reopening policy of the country as well. But before we go further next year for the remaining of this year, let me give you some background of how Thai economy has performed in the first half of this year. Actually, and it has an implication actually to the policy stance going forward as well. Okay, so the GDP of the first quarter actually of Thailand actually beat the expectations by the analysts and by the Bank of Thailand as well. And the growth driver during the first quarter was from the recovery of the domestic demand, which was prompted by the easing of virus curves. Right, the lockdown was not gone, but it was eased. Okay, and a growing number of the visitors after the country reopened as well as the introduction of the government stimulus packages. But looking ahead, okay, we expect a rebound in the tourism sector as well as the service sector, which will be backed by Thailand's reopening policy and the easing of the border restriction in other countries as well, because it's not just about that we open the countries and people, foreign tourists will come to Thailand. It also depends on the policy abroad as well. So if other countries, they open their border, their citizens will visit other countries, and Thailand is one of the very famous destinations, right, that you know about that. So we expect to welcome around 7.4 million foreign tourists this year. And this number is higher than last year. So that's why we say that the driver will be tourism sector, because last year we have no growth, but we had a contraction actually. And this year it will grow. Okay. But on the domestic front, that was from the external sector, right? On the domestic front, economic activities in the service sector should also pick up the pace. Okay, as people will begin to spend more time outdoors, because we expect that government to lift the lockdown measure. Actually, they already did, and so that's why we think the money that was saved up during the pandemic will be spent more in the coming months, and that is called the pent-up demand. Okay, because actually, if you look at the money or deposit in the commercial bank, you will see that in the past few years it has increased sharply because people can't go out and spend, and also precautionary saving is also higher because they think that the uncertainty is too high during the pandemic period, so they don't spend. But going forward, as we have the lockdown measure lifted, we expect them to go out and use this save up money. So we expect private consumption to increase. So on the outside sector, we have more foreign tourists. Inside, we have lifted lockdown measures, so we expect higher consumption and investment. Okay, that is the good part of, the good part of Thai economy for this year. But the story does not end just like this. We also have some drag in the Thai economy as well, and the main drag will be from export. Okay, and export, you may have known, export has been the main driver of the Thai economy in the past years, right? But it will slow down this year. Okay, and we expect the growth to be at around 5.8% this year, which is lower than the previous forecast. We previously think it will go over 6%, but right now we revised the number down. And if compared to last year, actually export growth was 2 digit. So this year will slow down quite significantly, but 5.8% is not that low. I mean, it's still robust, but just lower compared to last year that we had 2 digit growth. Okay, and the reasons that the export growth will soften are the global demand, because we expect global demand to slow down, as well as the world trade number. And the main reason that the slowdown in global growth is from the major economies. You may have heard that many international organizations has came out and revised down the global growth. Both IMF, World Bank, BIS, or Bank of International Settlement, they also revised down their growth. And the main reason, let me share you about this. I think it's quite important and it's quite interesting. The main reason is that both all the major economies in the world will face a slowdown this year, both in the US, the EU, and China. Okay, if you look at in the US, the economy will slow down thanks to the tightening monetary policy by the Fed. The Fed is the central bank of the America. Okay, we expect them to hike rate for another 1.75%. Actually, in the first half of this year, they already hiked 1.5%. Just 6 months, they increased their interest rate for 1.5%. It's very high, right? And going forward, they will hike another 1.75. So this will slow down the domestic demand in the US. And so we expect consumption to slow down as well in the US. And for the EU, they are most affected by the Russia-Ukraine war, right? You know that EU country, they depend on the energy supply from Russia.
Yes.
Quite a lot, yeah, especially Germany and Italy. So they face high inflation and they have supply disruption problems. So that's why we expect a sharp slowdown in the EU countries. But we don't see recession yet as of now. Maybe the growth in Germany might be lower than 1%, but not just something like a crisis, but sharp slowdowns, of course, in the EU. And next we have, yeah.
And about the slowdown of Thai export, as you say, is it also because of Thai baht getting stronger?
No, actually, Thai baht benefit export sector because actually, if you look at the Thai baht movement in the past month, it weakened a lot, 6%. All right, 6% depreciation, and when baht depreciate, it will give us the exporter a competitive advantage against other countries that that have their currency appreciate against our Thai baht. Okay, so actually, even though this is a good point that you raised. Even though the global demand will soften, but we have weakening baht that will cushion the contraction of our export sector. And that's why we said the growth maybe it's lower than last year quite much, but it's still quite robust at 5.8 because we benefit from this weakening baht as well.
Mm-hmm. Okay, and many countries around the world are experiencing a very bad inflation in their countries. Mm-hmm. And we also see inflation here in Thailand. But do you think that inflation in our country is a very serious problem, or is it still acceptable if compared to other countries?
It's quite high. Of course, we have to admit that the number 7.1% in the recent month is quite high, and it beat expectation by market analysts and by the Bank of Thailand as well. But if we compare this number, I mean, our inflation rate, and if we compare with other countries, you will see that it is quite low if we among those numbers in other countries. For example, in the in the US, the inflation is 8.6%, is still higher than in Thailand, and in the UK it's 9%. So it's, of course, we have higher inflation compared to the past few years, but the situation is not that bad compared to other countries. And the reasons that we have high inflation is because of the supply side effect. We have high energy price, high oil price. We have a supply disruption problem because we have a Russia-Ukraine war. And so raw food price also increased sharply in the past month. So that's why inflation pressure has been around for over the world. And yeah, it's quite inevitable for Thailand to avoid this situation. But also the reason that we have quite a low inflation compared to other countries, I mean, comparatively, we have lower number. It's because of our limited transmission from the global inflation number into our country. Do you understand? Even though if you look global inflation number, it's very higher than our domestic inflation. But this is because we have a limited transmission following our energy price control measures offered by the government. We have in the past, transmission from global inflation to Thai inflation was low, and because the government support the price domestically. Okay, so the price within the country does not soar, skyrocket. And according to our analysis, inflation from 2019 until today was actually attributed to the transmission of the oil-related import price of around 30%. Can you follow? 30% of our inflation is from import of oil and gas from abroad. Okay, and for another 10%, it's from non-oil related import price. And for the remaining of around 60%, it's the domestic factors. So we have to accept higher energy price, higher oil and gas price. We will have higher energy within the countries, and it's quite unavoidable. And weakening baht is also another factor, because when baht weaken, the price of import product will increase. So this could also pressure our inflation within the country. Okay, but right now we have the support by the government. But however, in the future, I mean, in the short run, at least the remaining of this year, we think the transmission is expected to be greater in the period. And this is because we will have a lower energy subsidies, because the government have a deficit fund, oil fund. We support for quite a lot. We spend like so many money in it, and the fund is in the deficit. So that's why we expect the subsidy to be lower. Okay, and moreover, we also expect larger cost pass-through from the producer or manufacturers to the consumers, because and this is because we think the economic recovery will kick in, right? And we have an improvement in labor income following the easing of the lockdown measures. So actually, in the past, if you look at the number of the PPI, or it's called Producer Price Index, PPIs, you'll see that index has increased much more than the CPI. CPI is the Consumer Price Index. And this has reduced the producer profit margin, okay, as they cannot pass the rising cost to the consumer because the domestic demand was quite weak in the past month. But we think from now on, the situation will start to change, because the producer will try to pass more of the rising cost to the consumer, because right now our economy has recovered, right? And we expect the ease of lockdown measure, the domestic demand will be more robust. So producer, as they bear the higher cost themselves, they will start to to transmit the rising cost to the consumer. So that's why we think, in summary, we think inflation will remain high in the coming 2 or 3 months, because the price will still high, and the pass-through may be larger.
What is the acceptable rate of inflation normally?
I think it should be within the policy target range. This is by theory. I mean, economists was taught that the inflation should be within the range of the central bank. And right now in Thailand, we have the range of between 1 to 3%. So 7% is a lot. It's high, and that's why we see Bank of Thailand try to communicate and try to prompt the market that we will have higher interest rate, so that they want to tame the domestic demand down in order to bring down the inflation. But another point, which I think is more important, is about the cause of inflation. If inflation came from demand pool, I mean, if our economy grows strongly, okay, people spend because they have money to spend. That should be a good thing, as you said. It is a sign of our growth of the economy. But the problem is inflation in Thailand is mostly from the supply side. It's from high oil price, which we cannot control, which the Bank of Thailand cannot control. It's from rising raw food price. It's from the supply disruption. The cost of production is higher, and this is not a good thing for our economy. And even though Bank of Thailand try to hike their policy rate, but it will just slow down the demand side. But the supply side problem is still there, and that is it's the problem that every countries in the world are facing right now. It's the cost push inflation. So what we have to do is that we wait for the good to happen. We wait for if the energy price become lower, or the war between Russia and Ukraine is solved, the problem should be eased. Yeah.
Okay, and the Fed in United States already raised the policy interest rate few times this year. Do you think this will have the impact for bank in Thailand to raise their interest rate further as well?
It will actually pressure our bond yields, especially the long-term 10-year bond yield, Thai government bond yield. But for the pressure on the Bank of Thailand to hike their policy rate following the rate hike in the US, I think it's quite limited, because we have quite strong external stability. We have large international reserve. We have low public debt, low foreign debt. So even though they hike, in the US they hike rate, Thailand should be able to cushion the volatility that will happen in the financial market. But let me talk about this. When the Fed hike their policy rate, they will have an implication to the global financial condition, right? And we think that would be like 3 channels. The first one is, of course, higher interest rate and rising bond yield. Okay, so it will make the borrowing cost of the business and household sector, and as well as the mortgage rate in the real estate sector, higher. And a rise in borrowing costs will tighten the financial condition and potentially depress demand and economic activities. That is the first channel. The second one is about the capital outflows and weakening EM currencies. A rising US interest rate will potentially attract more capital inflow back to the US, okay, following the higher return of holding US dollar or holding US assets. And as a result, US dollar is expected to appreciate against other currencies. And other currencies, are particularly in the countries with easing monetary policy, will have a large interest rate differential compared to the US. And that will cause a depreciation of their currency. And so Thailand, we also face this problem, and that's why we have Thai baht weakening. Okay, and the third channel is about global liquidity. Okay, as the Fed, they just don't only raise their policy rate, they also decrease the size of their balance sheet, and we call it quantitative tightening. It's the opposite of the quantitative easing. So their balance sheet will be smaller. The money in the system, global financial system, will be lower. And this will decrease the liquidity right in the system. And thus it will decrease the global investment in risky assets going forward. And the return on the stock exchange in EM is expected to be lower. So this is the main impacts from rate hike in the US. Okay, rising cost, capital outflow from EM, and lower liquidity, lower stock market return.
Okay. And now some people may still wonder how rising interest rate could slow down the inflation. Can you explain?
Yeah, actually, rising rate would make the domestic demand to soften. Actually, if we talk in the context of Thailand, I think hiking policy rate will not bring down the actual inflation in the coming months because it has to wait until the transmission work, and usually it's around 4 to 6 quarters. So we might have to wait for another year, and because when they hike rate, the investment will be lower, consumption will be lower because people will save more, and they might postpone their consumption into the future. And investment will be lower because cost of money will increase. Okay, cost of production will increase, so the demand for investment will be lower. And also we have expected default rate to increase as well because rising borrowing costs, maybe they can't roll over their debt. And so some firms, especially the vulnerable one, might default. So domestic demand from investment and consumption will decrease, but this thing will take time. It might take another year to occur. But the channel that will work on right now, it's about expectation. And I think this is very important because we don't look only at the actual inflation, we also look at the expectation. Because when people expect price to increase, the point is they will adjust their pricing of their product and service, right? If they expect inflation to rise, they will just try to sell at higher price. And for labor, they will negotiate to have higher wage because in order to cover with the inflation pressure. And this would be a feedback loop. When inflation is expected to be higher, we have higher price. So higher price means higher inflation, and it will be a feedback loop. And the Bank of Thailand is scared of that. Actually, every central bank is scared of this higher expectation. And what is higher inflation expectation? Actually, it's from the survey based. They will go and ask household, what would you expect the price level to be in the next 1 year, 2 year, 3 year? And actually, if you look at the number, right now in Thailand, the numbers start to increase over the target range of the Bank of Thailand. And that is a sign that they have to do something. So that's why they try to adjust their monetary stance, because right now we have historic low interest rate. Okay, our policy rate is at 0.5% right now, and it has never been lower than this. So they think this policy rate is too low because right now our economy has recovered quite well, and going forward we have a benign outlook. So that's why they signal that the policy rate will increase in order to curb down the inflation expectation by household and by entrepreneur. So the point is that hiking interest rate, we cannot, and we accept that we cannot bring down the actual inflation next month. We can do, but what we can do is that we will stop people from anticipating higher inflation, which will feed back into the actual inflation one.
Okay, so for a good of Thai economy, are you advising people to save more money, put more money in the bank?
Well, actually, it's time to spend because we have an ease of lockdown measure, and it actually we have saved up quite a lot in the past year during the pandemic period. So it's time to spend more. But
it's
talking about spend
money.
And this is the environment that occur in many countries. In the past year, actually, in the U.S., they opened their country since last year, and you will see their consumption has grown quite significantly. If you look at their retail sales, it's in some months it grew at 2 digits, but part of it was because of the low base. but still you see that consumption in the US has been very strong. Okay, and that's why the Fed interpret as an overheat of the economy, and that's why they hike so much in this year. So we expect the same thing in Thailand, and right now you see if we go out, we have traffic jams. People go out and spend more
Just
in
like
the
before COVID.
yeah. So
Okay. And my last question,
mhm.
as most of countries around the world now is easing their COVID prevention measures, what do you think is the greatest challenge for Thai economy from now on?
I think the challenge is still the issue of inflation, okay, and maybe geopolitics problem. If we still have the war occur, especially in the Russia-Ukraine, and we cannot bring down the supply disruption problem, and the price of energy is still high. I think the problem is that the domestic energy price will increase sharply because our oil fund has been negative for quite a while. So we will see the rise in inflation so much, and that would be a drag to our consumption and investment. Okay, and another thing is that if the Fed hike their policy rate for much higher than anticipated, this could take the money out. I mean, we can see the capital outflow from Thailand, and it might pressure our bond yield and Thai baht as well. And if we have weakening Thai baht further, it would again pressure our domestic inflation. Okay, but still, even though I say this, it seems like quite a scary thing. But I have to say that we still have a very strong external stability in Thailand. So I think in our base case, it is that we can still cover with those risks because we have high foreign international reserve. We have low public debt, low external debt, even though we have deficit current account. But going forward, when we welcome more of foreign tourists, the current account will turn surplus at the end of this year. We expect surplus current account. So judging on these indicators, it reflects that our external stability is still firm. So we should be able to handle the capital outflows. And Bank of Thailand, we have much money. I mean, even though there are demand from the foreign investor to take out their money, but still Bank of Thailand can go out and intervene in the exchange rate market in order to lean against the wind. What we use is that to try to tame down the weakening bias of Thai baht. So yeah.
Okay, so we hope to see a better recovery for Thai economy in the second half of this year. And thank you, Kun Washiravat, for talking to us and coming to our program today. Thank you.
You're welcome ครับ
ขอบคุณนะครับ And that's all for Voice of the Nation today. Thank you for staying with us.